Hope you're doing well. So let us continue with our practice of price action on real-time market charts. I have also taken the feedback from some of the comments that the audio in the previous Nifty video was not very clear, and this time I have placed the speaker in front. So I hope that there is some improvement. You could leave your suggestions as always in the comment section. So we'll continue today with the assessment of another index, and we will use the same concepts and the same principles that we discussed in our previous video, and we will use price action exclusively in order to form an opinion. And just going alphabetically, I decided that since we had discussed the Nifty chart in our previous video, today we could just start off with the first of the key sectors, which is the Nifty Auto Index. And so as usual, as you are familiar with my process of assessment, particularly when I'm doing it socially, we will set it up on the monthly time frame in order to have an understanding of what it is that we are looking at. And we can see that we have a price action record since around 2011-12. And the interesting thing about the price that we can see is that if I mark this horizontal line here, which you will see, I'll just darken it a bit. Maybe I'll choose blue and darken it a bit. You will note that from a high of approximately 12,000, this index corrected to a low of approximately 4,500 in COVID. And the breakout from the high, actually, I mean, if we can consider this point where the cursor is marked, the breakout from the high actually happened in July-August of 2022, which is after a near 5-year correction. So obviously these are the 2020 lows, but we can see that the index had created its high in 2017. So from 2017 right up till 2022-23, the index was actually in a range, and the first real breakout of the trend has happened somewhere around this time where the cursor is marked. And we can see how the market was not ready to fully accept that a real breakout has happened, because this is the monthly chart, and if we closely look at the phase here, I'll just mark this phase. So I'll just try to mark this phase here. We will see that the market spent a good 3, 6, 9, almost 9 to 10 months in this zone, the exact 12,000 to 13,500, which means it remained in a 6% trading range for a very, very long time, till finally it decisively broke from 13,000 and went 13,500 and went straight till 27,000. And it is now obviously we have our previous reference points which are created. It's time to set up a new reference point, and we can see that this blue line marked here is clearly the higher top. This is a structurally bullish chart, and any structurally bullish chart, obviously we are doing this assessment in order to form a bias, and if we see a structurally bullish chart, our bias is always going to be on the long side. That is, we want to buy the dip. And of course, after creating this high of nearly 27,500, the index subsequently corrected in the same manner that Nifty corrected. So we can see how correlated these charts are. And let's just mark a good round figure of 20,000, though the real correction seems to be closer to 19,000. So somewhere around 19,500 is basically where we see the correction of this chart. And now these two blue lines officially mark the trading range of this security for the full year. We can obviously ignore the previous lines as they are formed because they are not going to be they're not levels that we are really keen on, but they were just a part of our assessment that we had an index which remained in a trading range for almost 6 to 8 years, then broke out and doubled in value, and has now given a pullback. And when it did break out, it created an all-time high. And as we have understood that if any security creates an all-time high, it is necessarily uptrending, and we will always look to buying it. But this is the assessment done on the monthly. All the trading action actually happens on the shorter time frame. So we will just lower the time frame and now move on to the weekly charts. So this is how, obviously this is how our assessment looks on the weekly charts. These levels are created after a quick glance on the price. And when we look at the weekly charts, we obviously need not see everything from the beginning, but rather we now focus on the zone of our interest. That is, we have marked the high and the low of the zone, and we start looking for patterns or hypothesis in order to support our bullish bias. Why the bullish bias? Because it is coming from the monthly, that we are seeing a security that has created an all-time high and a pullback. And generally when that happens, we know that a security can always change its trend, or it can always become a range. But as trend traders, we will bet on the direction of the continuation of the trend. This is the style or the philosophy that is adopted by trend traders, that they will bet in the direction of the previous trend. That is, they will assume that the trend is more likely to continue, or that it is more profitable to make a bet in that direction, and therefore they execute that system. So any which ways, we will come back to the weekly charts, and once we come back to the weekly charts, we can very clearly see without any ambiguity. Now I'll just mark this blue line here. We can see without ambiguity that this zone is a real resistance. So I mean, if I just select the rectangle here, so that we are all on the same page, you will see how much this 24,150 level on the index, what a strong resistance this has been, because this has been a resistance in play right since October 24. And we are we are obviously now in August, or let's say September 25. So pretty much 10 to 12 months has elapsed, and only after a full year could the market break this resistance. Now that this we have understood that this was obviously the zone of resistance. When we zoom in a little bit further, we will see that not only did the market actually break this resistance, it has actually broken it with a full gap, and this becomes all of a sudden very bullish. If there is a way in which I could just select, let's just say, a trend line here, you would just have to see the structure that is getting formed. If you could just visualize, or maybe a trend line is the wrong instrument. I'll just see if I can find a curved line, which is not here. Okay, so maybe a brush might do. So you just have to focus on, by and large, how the price is structuring here. And then, if I don't have a mouse, I'm just using the touchpad in order to make this. But it's looking quite hideous. But the point being that this zone looks like a saucer. This curve looks like a saucer. This is actually the point that I was trying to make. And the name of the pattern per se is not really important in technical analysis. That is, it's not important that we know the name of the pattern, like say head and shoulder, or W, or saucer, or rounding pattern. But it helps if it helps in communicating with other traders that this is what you're seeing. But by and large, all patterns have a very similar rule. The high and the low of the pattern become the target, right? So for example, the high of this, if you just zoom in a little bit and we ignore what is happening here. So this high, this is 24,150, and let us just call this approximately 19,150. I'm just giving it a round number. This distance is approximately 4,500 to 5,000 points. So logically, a break from 24,150 should also send the security around 4,500 to 5,000 points up. And which means that we obviously have the previous high as a resistance, but approximately 4,500 or 5,000 would send the security somewhere here. So to sum it up, because there is a range break, as we can see here, pardon, sorry, So because there is a range break, as we can see here, this is obviously a technical breakout of a range, and it is in the long direction. And the reason why we are going long direction is obviously here because we are seeing an uptrend higher bottom. So we are looking at the long direction. We are seeing a saucer pattern, though the name is not necessarily important, but we can clearly see a range break with range high and range low of approximately 5,000 points. We see that it took a full year to approximately 10 months to create this range and break it. Now, this actually, if you remember, we discussed the flagpole pattern in Nifty the other day. The realization of this target will be much sooner. That is, it will not take another 10 to 12 months, but really it should, in general expectation would be that it will take half that time to reach the target. So what is the target? Target is the blue line that we have drawn ahead. The previous high has no reference to us for now because we are looking at a bullish pattern. We are trading the pattern. Obviously, this particular level also has been known or identified, and this low has of no bearing for us because the pattern low that we are interested in happens right here at the zone of consolidation. So I'll just mark those zones right here. So here, so I will mark this. I'll in let's just say red color. And the purpose of saying red color is that I would ideally like to buy on the blue line, which is 24,150, and would like to have a stop loss on the red line. And the reason for buying would be that a structurally bullish stock, which is right here, has given a range break. And since the stock has a bullish structure, we will keep a long bias, and since it has given a range break of a long bias, we will take the trade. When a structurally bullish stock gives a range break on the down bias, we ignore that trade. So once again, I'll repeat that as trend traders, if we identify a bullish stock giving bullish range breaks, we are obviously going to be keen on taking those trades. But if a bullish stock gives a bearish range break, we just simply ignore it. We ignore what is happening on the shorter time frame. So we obviously can see that we have this gap as a support. We know that the pattern fails along these red lines. So I will have somewhat here marked as exit. This is where the pattern would not be working. The trend would still be up. But the reason we took this trade would no longer be applicable because the pattern would no longer be working. And now the question is, why should let's just assume the price is to correct and come all the way down. Why should we leave? Because the entry and the exit value gives us the risk per share. And let's just say if I decide that I want to risk 10,000 rupees or 1 lakh rupee, I'm going to buy those many units of stocks. So my quantity is a function of my stop loss. So in trading success, what value you enter has absolutely no signification if we see that in isolation. That is, it doesn't matter if you buy this index at say 19,500. That does not matter. What matters is that what was your stop loss, where was your target, and did you trail it? Because if you buy just one share of a stock at ₹1, which eventually becomes ₹100, even though on paper it looks like you have made 100x returns in a year or few years, the reality is that you just made 100 rupees. And if our objective is to make money in the market, we should stop looking at percentage changes, but rather look at risk in absolute terms on a unit share basis and then multiply it by the number of shares we want to take. Since I am talking about the index, obviously you will not find stocks, but you will not find shares getting traded. But the knowledge or what we learn here can be applied into similar stocks. So coming back, we can zoom in even further now. We are looking at a range break. We want to buy it. We know our exit. We know our dream entry, and we saw that there's a clear gap. Let's just move on to the smallest possible time frame. That's the daily. And you will see that our dream entry value of 24,150 and our exit value of 3,350 is approximately 4% or 5% on an index value. And we have already marked our target. That is, our target is approximately 29,000 because we are looking at this full range. And here on the daily, you would note, now if I can take a trend line, this is a very perfect W pattern. I mean, I wouldn't call it a very easy to trade W pattern, but definitely a clear W pattern is visible here, which means that if we have a bullish bias coming from the monthly, and if we see bullish patterns on the shorter time frame, that is the daily and the weekly, we should get ready to take trade in that particular direction. So and obviously when securities extend like this, you will start seeing other theories of trading related to harmonics, etc. But having said that, coming back to this, we can now, I mean, if we basically see this entire blue line here, I mean this I would say right till here, and I'll color this blue. Somewhere around this line is basically where we want to enter. And I mean, obviously I have long positions on auto stocks, and like I mentioned that I don't trade patterns directly, I trade momentum, and a momentum is a subset of a pattern, and if a pattern is really in play, then it will show bullish momentum which will drag me in. We are discussing for academic purposes how to use price action to form an opinion and how to form a trade. And you will see that the levels of our entry, the levels of our exit, our consequent stop losses, and the risk per trade, all of it is coming from the chart. We do not decide it as a trader, and the only thing that we can decide is the quantity that we buy, which means that you could actually make this blue line here also, that you would like to enter here. But the higher the level at which you enter, more is the risk per trade on a per share basis, and therefore you will end up getting fewer quantities. So assuming Nifty Auto were a stock and not an outright index. Anyways, I hope that today's example in conjunction with the previous example on the index will add some value, in which you see how we use assessments from different time frames to lead us into a trading action or a trading bias on a smaller time frame. And you can repeat this process. I start off with monthly, weekly, daily, because it's easier to communicate on social media and with many people if the time frame is large. But if you're practically trading and you want to do it on a shorter time frame, you are obviously more than welcome to exercise this process of decision making there as well. If there is more that you would like to learn, I have shared the link of a course that I have taken in Upsurge. I'm quite proud of that course personally. I feel I have done justice to the role that was assigned to teach a group of students. And I was also very fortunate to have found students who were above average in their understanding of the market. So I didn't have to spend time with things like, what is a call option, what is a put option, nothing like that. We got straight to the meat of the matter. So I have shared link a description to that as well. And I would also like to inform that pretty much on the same topic, tomorrow I have a live webinar with Upsurge at around 5 p.m. That will be a YouTube live. If time permits and if interest permits, I would be very happy if you can join. And if you have any queries, you can, I think, direct them directly on the comment section in the live chat, which the individual will, I mean, if it depends who is taking that live chat with me. But the person concerned will read out that question and usually highlight that question. And in tomorrow's topic also, we will be discussing pretty much the same thing that we have discussed in the past, but I just thought I'll let you all know. With that, thank you for your time and interest. I wish you all the best. Good night.